Have you ever wondered how interest rates work? Let's dive into it. Interest rates are, in essence, the cost of borrowing money. Think of it like a fee you're charged for using someone else's cash. This fee is often expressed as a percentage of the total amount you're borrowing. So if you take out a loan, you'll need to pay back the original sum, plus this additional percentage. That's the interest. So, in simple terms, interest is the price you pay for the use of someone else's money. Now, you might be asking, how are these interest rates determined? Well, it's not as simple as picking a number out of a hat. Several factors come into play. One significant factor is inflation. When prices are on the upswing, interest rates tend to follow suit. This is because lenders want to make sure they'll get a return on their money that outpaces the rising costs. The overall state of the economy also has a say in this matter. In times of economic prosperity, interest rates often rise as more people are willing to borrow and spend. Conversely, during economic downturns, rates tend to fall to encourage borrowing and stimulate the economy. The level of risk associated with the borrower is another key determinant. Higher-risk borrowers, those with less stable financial situations, usually face higher interest rates. And let's not forget the role of central banks. They have a crucial part in controlling interest rates, setting the base rate from which others are derived. Therefore, interest rates are not just arbitrary numbers, but are influenced by several economic factors and risk assessments. So, why should you care about interest rates? Well, interest rates have a significant impact on our everyday financial decisions, particularly when it comes to borrowing, saving, and investing. When interest rates are high, borrowing becomes more expensive. That car loan, mortgage, or credit card debt, they all cost more. But it's not all doom and gloom. Higher interest rates can be a boon for savers and investors. Your savings account will grow faster, and investments that pay interest can become more attractive. On the flip side, when interest rates are low, borrowing becomes cheaper. It's a great time to buy a house, start a business, or refinance existing debt. However, the downside is that low interest rates can erode the value of your savings and investments. So you see, interest rates are a bit like a seesaw, with borrowing on one side and saving or investing on the other. In conclusion, understanding interest rates can help you make smarter financial decisions, whether you're borrowing, saving, or investing. Let's quickly recap what we've learned about interest rates. They're essentially the cost of borrowing money, determined by factors like inflation, economic conditions, and central bank policies. These rates play a significant role in our financial activities. They influence our decisions on savings, loans, and investments. When they're high, we're more likely to save, and when they're low, we're encouraged to borrow and invest. And that, my friends, is the fascinating world of interest rates in a nutshell.